In fact, let's take that conversation forward. Vinod Karki, Head of Strategy at ICICI Securities, joins in on the show right now. Vinod, hi, morning. The debate everywhere is whether to ease off from mid and small caps right now, and is it time to now bet on return of large caps? And, off late, that quite clearly seems to be playing out as well. I mean, the small cap index is already off 10% from its all-time peak.
Well, yes, I think, it's a case of relative performance. You see from last year when the crisis in the European banks started, the Nifty itself is up 30% odd, so which is not a bad returns, given that expected returns from large caps is around 15% odd, which is quite good. But the thing is, mid small caps have gone 60% to 90% if you go to the micro caps, So that's the problem. And over the last, that period, the earnings growth has expanded by anywhere between 15 to 20%, given which index you're talking about. Obviously, the smaller indexes have grown faster. But the point is, if the price increases by, let's say, 70, 80%, and earnings expanded by 20%, then obviously the rest is made up by fee expansion. So that is where the challenge arises. It's not a case that growth is not coming by. Growth is looking good. In fact, the GDP growth got revised upwards, which typically, and that too driven by investment rate, the real estate cycle and all picking up, which is typically good for the SME segment from a fundamental perspective. But I think the market is taking it a little ahead of its of the fundamental angle, and valuations are rising very rapidly. So that's the thing. It's a classic dilemma for small cap investing, where the valuations are getting more and more uncomfortable. But there is no denying the fact that broader based economic recovery is gaining pace, basically. Yeah.
Valuations is something that this economy is seeing some picking up pace as well. Vinod, good morning. This is Vinny joining in the conversation as well. Also, I want to talk about in terms of when you look at it in certain names and real estate sector as a whole, how do you see in terms of that up move going forward as well? We had seen a bit of a run up coming in. That cycle has started picking up for the real estate sector. Do you think that is something that could continue in the next couple of years?
Real estate, if you see historically, the upcycle or down cycles have lasted anywhere between 5 to 10 years, basically. So if you look at the current cycle, I think we are in the second year of the upcycle. So that means there is headroom left. And given the reforms like RERA and the whole crackdown on cash economy and all, and this will be one of the most transparent real estate cycles that India has ever seen. So I think the longevity will be there fundamentally. But obviously, the stock prices are reflecting a little ahead. That's how markets behave. Wherever there is positivity and things are looking good over a longish period of time, things start to run ahead of fundamentals. Which doesn't mean that the cycle will not be played out. The cycle will play out, the 5 to 10 year cycle that we typically see. So, but you have to look at valuations where things are a little okay. So I think some of these segments which are ancillary to the real estate players in terms of, let's say the building material or even the lenders, mortgage lenders, where valuations are reasonable. I think these are much better from a valuation perspective. Direct real estate players, I think, has run up quite a bit. So valuation comfort is lesser over there.
Interesting. Vinod, where else are you finding value in the market? Or would you say, it should be a more of the same kind of strategy? Would it be the Capex, infra plays, etc.?
Well, the Capex companies, the industrials have made their moves. But as I said, these fundamental moves continue for several years. So they especially some of the large cap names are not at very high valuation. They are at higher valuation, but they are not extremely high valuations. Some of the large industrial companies that we talked about in the report. So that is one. And if you look at the large banks, so when you're talking about the investment rate and investment rate driven GDP expansion and real estate cycle picking up, That doesn't happen unless you have overall re-leveraging cycle from the financials. So, and at this point in time, the largest contributors to the re-leveraging cycle, the large banks, I don't think they are at very extremely high valuation or something like that. So from a growth and value perspective, we find large financial companies to be the best bet on the cyclical recovery that we're seeing in the GDP expansion, where the lenders to the economy will benefit a lot. And we are at the bottom of the NPA cycle. So there's quite a bit of time left before NPAs really start troubling us. So from a growth, NPA and valuation perspective, I think large banks are the best.
Large banks are the best that you could make a bet in terms of that. But in terms of overall the defensive sector, what I'm seeing is that in a report you mentioned that you're downgrading the defensive sector in terms of a play that is coming in there. Why is that so? Any specific reason for that?
So if you see the downgrades that we have seen in terms of earnings over the last year or so, when this index movement has happened, if I combine the aggregate earnings base of, let's say, the FMCG, IT, and pharma together, the aggregate earnings base for 24 and 25 actually has been downgraded by 4 to 5%. That's what we observe. And there is no, I mean, we don't see that the valuations have reached a level where we can say they are very comfortable or they're getting very attractive, both from IT, FMCG especially perspective. So I think this is the space, the exactly opposite, where valuations are quite high. I mean, historically, if you see from a longer period of time, a decade or so, the valuations are on the higher side. But we are getting growth downgrades for these segments. So that's the thing, basically. Once the valuation starts getting into comfortable zone, obviously these are sustainable sustainable growth companies which are of good quality, no doubt about that. But currently, growth is getting an issue, and valuations are high over there.
Right. So obviously valuations are still high, but in terms of, specifically in the defensive side, IT, right? And mid-cap IT is what if I look at, that has not been bad in terms of something like a KPIT Technologies, in terms of the guidance that they've given as well. You would still wait off on that front because of the valuation, only that would be the reason?
So two things. One is, if you just roll back to IT valuations 4 5 years ago, or when there was this growth concern. I mean, what ignited this whole spark in IT companies was post-COVID period, when people thought that digitalization will pick up significantly and there will be a huge jump in their order book and growth, which we are seeing currently that it's not happening. Post the whole euphoria around working from home and digitalization and things like that, I think that's dropping. And the bigger thing is, we are hearing large big tech companies talking about significant productivity gains from AI, so which we don't know. I mean, that's something. I mean, these companies are driven by long-term expectations of sustainable growth. So if there is something lurking over the medium to long term, which can disrupt this business model, so that one should be a little careful and try to give at least mid-level valuations, not top of the cycle valuations to these companies. That's the concern. I mean, individually, there will be companies which will be going at a fast clip, and there'll be million stories. But from an overall perspective, it seems that the valuations are at top of the cycle, and there are some concerns, structural concerns around demand for the traditional IT services that India exports.
Okay, Vinod, thank you so much, for joining in with us, giving us your insights on the market as well. Thank you so much for tuning in with us on ET Now.